Good evening, everybody. Fall here in the Pittsburgh area. And tonight we got the great pleasure of having Serge Berger back with us. He is excellent as far as strategies for producing steady income using options. So he is probably one of the, foremost traders that you will come across. So he's got excellent strategies. So with that, Serge, we're anxious to hear your information. Welcome to the Candlestick Forum again.
Thank you, Stephen. I appreciate it. All right. Welcome, everyone. Good evening, or I guess it depends where you are. It could be morning if you're in Asia, I think, right? Anyway, hope you guys are all doing well. Again, I want to thank Stephen and the Candlestick Forum for having me on here today. What we can talk about today is options credit spreads for monthly income, and there's a very specific strategy that I'm going to be applying here today, one that has its nuances and which is why it works. So I'm going to go through this very systematically with you to make sure that you understand this and you can start applying this as soon as possible. Just to give you a quick information or backdrop on me, I've been very fortunate to have worked both on the buy side and the sell side of Wall Street, so places like JP Morgan and family offices and things like that. And not only has that allowed me to see multiple different asset classes like fixed income and options and equities, but it's also allowed me to work with some of the very best traders in the world. And so I'm very fortunate to be able to pass this knowledge now on to my direct clients, advisory clients, my students, and of course the broader audience such as yourself. So, before we get into the meat of the presentation, I want to make two quick and simple points. Number one is that I think it's really important to keep things simple when it comes to trading and investing, and I do know that Stephen tends to focus on that as well, so that shouldn't be a strange approach to any of you, I would suspect. So most traders and investors make things way too complicated because really they look at too many conflicting data points. We have to be able to eliminate that noise as traders and investors, and so the more straightforward that your process is going to be, the easier it will be for you to be able to actually stick with it. And I know the very best professional traders that I know and that I've worked with for a long time, they have a very simple but a repeatable, and the key here is a repeatable process. That's point number one. And point number two quickly is that I think it's important to point out how great a time that we live in for the self-directed trader and investor. We've got a globally dynamic and interconnected markets and economies, social forces that are basically forcing also technology become very mobile, and it's actually allowing us to be able to do and manage our own money and trade and invest pretty much from anywhere as long as you have a process. And that's the key. You need a process. You don't just need a tablet, you actually also need a process. The last bit on this quickly is that from the perspective of liquidity and transparency, I think it's important to respect the fact that we live in the adage of ETFs and, again, a globally connected market that really allows private investors to be able to trade the global markets from their home, and also, again, using instruments like ETFs and stocks and things like that pretty much, they don't really need to necessarily open up different brokerage accounts for that to happen. So anyway, just want to give you guys a quick backdrop of that. So having said that, I've got a quick question for you. This quick question here is, does your profit and loss curve look something like this, or do you know of someone whose profit and loss curve looks or has looked like this at some point in the past, where you're making some money, then you give it all up, then you make some more money, and then you kind of give it back. So basically you're kind of like flatlining, right? I'm seeing some comments in here. That's exactly kind of my point. And to be honest with you, this is kind of what the majority of people's profit and loss curve actually looks like. Or, it could look something like this. And this is actually, unfortunately, way too many people have a profit and loss curve like this, where they lose some money, they make a little bit, they lose even more, and so on and so forth. And you can kind of see where this is going to. Well, in order to avoid this, there are obviously multiple things that we need to do, but one of the most important things for me is to be able to understand that traders and investors need income, okay? And this is really, really crucial. Monthly income, or at least quarterly income for traders and investors, is really, really important. Not having that monthly income is one of the biggest pain points for private traders and investors. So, for example, how much more calmly would you trade if you knew that you had steady monthly income? Like, for example, if someone were to give you whatever, 3, 4, 5, 7, 8, 10,000 a month at the end of every month, regardless of how you did in your trading account, wouldn't you trade more easily? Like, wouldn't you necessarily not feel stressed, right? So this is a really important concept. And this is also going to be really, really crucial. I'm going to show you folks here, whether you're retired or semi-retired, or you have a job or a part-time job. This is the kind of strategy we need to focus on first and foremost. And I think a lot of the folks that like to focus on the swing trading and things like that is okay, but I think it's primarily important to have a look at this through the lens of income. So let's take this a step further and give you a little bit of feedback. I remember when I used to work at the trading desks, particularly the one at JP Morgan, I was paid a lot of money just to sit there. And there's a reason besides the fact for, let's call it, that they tend to fight for talent, if you will. It's, you get paid because they don't want you to force trades, one of the reasons at least. And so that way we don't have to force trades and we don't have to dig ourselves into any holes. So it's that stress of volatile returns or no steady returns at all that's driving people nuts. I've been there, trust me, I really don't want to go back there. So what I'm going to show you today is how I managed to generate this steady sort of monthly or quarterly income from the markets. Okay, of course, if you're a trader at a bank or something like that, ultimately there's a risk of getting fired if you underperform. So really there's not a whole lot that you can do right there either if you really think about it, if you trade for one of those places. So anyway, let's continue a little bit further on this concept. Again, importance of monthly and quarterly income. I think private investors need regular income. Number one, it's really a psychological thing. They need it in order to get into and remain in the right frame of mind. They also need it because stagnating or losing accounts over time will lead to you losing confidence in the strategy and ultimately even in yourself. And so breaking rules and forcing trades is sort of the next logical step of that. And of course, if you don't stick to your proper risk management, you end up basically gambling. And that's not really what we want. Everyone feels better with some sort of a regular monthly or quarterly income stream. And that's actually also why many people like that security of a job, right? A regular paycheck until, of course, ultimately there is that risk of getting fired. So what I'm going to show you guys today is a very low stress, high probability, and highly repeatable strategy. Again, I continue to reiterate the highly repeatable part, which is really important. The strategy, if it's done correctly, and again, I have to stress that if it's done correctly, has an 80 to 90% chance of profitable trades. So about 8 or 9 out of 10 trades should be profitable. And I'm going to show you exactly how it works today. Time requirement is not a whole lot. We're looking at about an hour per week. In fact, this is the kind of strategy when I was trading for a family office through the financial crisis in 2008, 2009. I was sitting there in New York City and I was having traders all around me trying to chase the market up and down. They were getting chopped up really badly. And so what I did is I actually applied exactly the strategy I'm going to show you guys today. And, I didn't make 300%, but I also didn't blow up. And we actually ended up making very nice returns, just taking advantage of the market in a very high probability way. So this this strategy, if you will, has also been stress tested through one of the most severe financial crises that we've had globally in a long, long time back in the last financial crisis. So let's have a look at this. So with this strategy, the market can actually go in your desired direction. It can also go sideways, or it can even go against you in the opposite direction to a decent degree, and you can actually still make money, right? So let's say, for example, in this chart here, you could, let's say you initiated a bullish bet here. The market doesn't have to go higher for you to make money. It can also go sideways. It can also go against you to a decent extent if you do it right, and you can still make money. A lot of the concept here is based on the fact that when slopes go from very steep to vertical, at some point they reach a point of extreme emotions, whether that's extreme greed on a rally or extreme fear on a sell-off, like for example here, right? At some point you can see when these slopes go from steep to vertical, they will reach a crucial point where the odds become so good if you're doing a certain type of trade that you can generate with it a nice income over like I said, a monthly or a quarterly sort of time frame. Okay, so let's have a look at this a little bit more closely. If when a steep slopes turn vertical, a couple of things tend to happen, and this is actually interesting because a lot of people aren't aware of this. Number one, implied volatility actually tends to increase or at least become somewhat more elevated or lift a little bit. And this is regardless of whether this happens on a rally or whether when the stock market falls apart. And we'll show you guys this in a minute. Investor fear or greed tends to reach extremes, and the reward to risk as such for what I would call a counter trend trade are absolutely amazing. And it's really perfect for the way we're going to do this, the trade that I'm going to show you guys today. So let's look at another quick concept before we start looking at the trade setup in more specific details. Let's go through a couple of option selling statistics which are really important to keep in mind. Generally speaking, the odds are strongly in favor of the option seller as opposed to the option buyer. Okay? Why? Because we know statistically speaking, about more than 75% of options actually tend to expire worthless. Which is to say that the longer you hold your short options, the better the odds are of success. In other words, options are a wasting asset because time is basically on the option seller's side. It's something we call theta. It's one of those options Greeks, and I'm not trying to get all options Greeky, geeky here. But the point is that options are a wasting asset. So if you buy an option, all else being equal, every single day it actually loses a little bit of value. But if we take the other side of that and become a seller of options, if it's done correctly, and that's the real big key here. A lot of people try to teach this kind of stuff, but a lot of people forget a couple of really crucial nuances that I'm going to show you guys today. Okay, so if you want to be an option seller, there's a couple of really specific things that you need to be doing that you cannot leave out. So option sellers on average even win if the market goes against them. Okay, and that's a really, really powerful statistic. So even if the market actually goes against you as an option seller, on average, you still actually tend to make money just because of the fact that 75% of options on average tend to actually expire worthless. So just keep these statistics in the back of your mind. Again, I don't want you to become too cozy with these statistics because again, you have to still do this in the right way. But just so you know, the odds certainly are in favor of the option seller. So here are the 4 steps that I would like for you guys to write down. Maybe you want to take this, take out your phone and take a picture of the slide, or just write it down manually, whatever you like to do. So what we're going to be doing here, and I'm going to show you this is a very simple and straightforward process looking at a few specific things, is number 1, we're going to be looking for steep slopes. Again, very specifically, steep slopes that have gone vertical and have given us signs of exhaustion. Very, very important. Number 2, we want to be ensuring that implied volatility of the options of the underlying asset that we're looking at are at least somewhat elevated. Okay, that's also really important. Number 3, we're going to be checking for liquidity in these options. And number 4, what we're going to be specifically doing, and again, there's a very specific way in which we need to do this. We're going to go ahead and sell far out of the money call or put spreads, depending on whether it's a bullish or a bearish bet, about 2 or more months out into the future. Okay? And then what you do is you rinse and repeat this on a monthly basis to build a portfolio of these kinds of trades. And again, the key here is in the specific, folks, because I know a lot of people try to tell you that option selling is the way to go for generating income. But a lot of the stuff that I see out there simply won't work because they're not doing a couple of really, really important points that I'm going to show you guys here in just a minute. Okay, so let's just have a look at a couple of scenarios, a couple of simple charts where you can see where the rallies have gone from very steep to vertical, and you can see each time that happens, again, a very steep slope going into vertical overshooting mode, the stock tends to at least stall, okay? Because what tends to happen through the lens of investor psychology is that the buyers, in this case, basically get exhausted, right? And it doesn't matter how you look at this. You can look at this through various statistics out there or just looking at through the lens of investor psychology, which is what I like to do. And I know Steve likes to talk about that as well, using candlesticks. So basically, we're looking at slopes that not just have had a steep rise, but actually ultimately go into this vertical overshooting mode. So again, this is key number 1. You can see here is another example. Here, for example, is the chart of Netflix. Again, it's nice to have a steep rally, but ultimately you need that real vertical blow-off kind of rally to ultimately get you to a point where these things get very, very overbought. Okay, so that's what we're going to be focusing on here to start setting up some of these trades so you can start to see how this works. Okay. And by the way, I should quickly point out, you can do this on daily charts, on weekly charts. You can even do this on near-term charts, like intraday charts, but we're really focusing on you're trying to building a system or a portfolio over time that's going to generate us automatic income through, like I said, a multi-month and maybe even a quarter, 1 quarter lens, that kind of thing. So let's have a look at this a little further. So when slopes go vertical, then the upside actually tends to be capped. In other words, or the downside is floored if you have a rally, a very steep sell-off to the downside. In other words, the asset will tend to stall in price. Okay? So it's really important to understand that when a stock goes that vertical, ultimately it's not necessarily that the stock has to fall apart, but the asset will tend to stall in price. And that's really the only real bet that we're trying to make here, as we'll talk about in just a second. Oftentimes, however, what you actually tend to see is that when a stock goes from steep to vertical, it actually tends to give you a fairly sharp mean reversion move to the opposite side, which is kind of your bonus. Again, that's not necessarily what we're looking for or hoping for, but it actually tends to happen more often than you would think. So let's have a look at a few examples here so we can kind of start sinking our teeth into the details of the strategy. Okay? So, for example, here we're looking at the chart of Facebook, and you can see Facebook has over time already had a very orderly, and I would call it a very steep incline, but it continues to have, and at the time when the example I'm going to show you, continued to have these sort of vertical bursts, and you can see it each time led to a mean reversion move, right? Even if the stock didn't fall apart, it did at least stall for some time, and that's really kind of what we are looking for. All right. So what I'm going to show you guys here is a specific trade that I put on in February 2016, where I went ahead and I sold an April 125-130 call spread, taking in a net credit of $1. Now, if this sounds like a foreign language to you, let me show you exactly what I mean. Okay. So let's go into the chart here. I'm going to show you the chart in real time. Just give me 1 quick second. So what we're looking at here is this is, again, the same chart I showed you a second ago. And essentially what the stock had done is that, it has a long-term trend and then it went vertical. So what happened once the stock went vertical, I sold here in the month of January, February 1st, 2016. I sold an April 125-130 call spread. So what I'm trying to do here is I'm not trying to make a bet on where the stock is going to go. I'm simply making a bet where I think the stock is most likely not going to go. In other words, what I did is I sold an April 125 call spread, so that was about here. So I was simply saying that the stock isn't going to go much higher than here, right? So in other words, from the current level where I sold the stock was trading around, let's call it $115. It could have rallied about 8, maybe almost 10% against me because I took it in net credit, okay? So I'm not making a bet of where the stock is most likely going to go. I'm making a bet where it's most likely not going to go. So in this scenario, you can see that the stock could have gone sideways, right? It could have gone lower, which is actually what happened. This is kind of like your bonus, right? And I'll show you some other examples in a minute where that didn't happen. And it could have gone up to 10% against me, okay, by April expiration. So there's a couple really key things here. Number one, again, I could have been completely 100% utterly wrong on this, okay, and I could still make money. That's number one. And number two, note, and I'll talk about this more in a minute, note that I'm not using options expiring on a weekly basis here like the week after or even the month after. I'm using options that are expiring a couple of months after, and this is really, really, really important, and most people don't talk about that. So what happened is by February 8th, that spread was reduced to 24 cents because the stock actually mean reverted very quickly. Again, this is the bonus, right? But I'll show you some examples in a minute where that didn't happen. And as a result, I got to buy back that spread and got to keep 76% of that $1, or basically 76 cents, or if you will, $76 of one time doing that trade. Again, very, very conservative and very specific. We were looking for a steep slope that went vertical, and then we were looking to sell an out-of-the-money calls, but at a very specific point. Again, this is a very specific strategy. We want to be very selective in this strategy. Let's look at another example here. This is Tesla, okay? And I'm just going to go right in and show you what the trade was. And here, I'm going to quickly bring up actually, I'll just leave it, this chart. On February 16, 2016, we had a chart in Tesla that went vertical. We had a vertical to the downside. So we had an already steep sell-off take place, and then ultimately the bottom kind of caved and it went into vertical drop mode. Well, on February 16, 2016, which was a little bit later here, once we had some bullish reversals take place. For those of you guys following candlesticks, I'm sure Stephen is teaching you this, and you're probably familiar. When you have a bullish reversal, you want to give things a little bit of time to qualify. But then by February 16th, we sold a June 120, 110 put spread for $2.25. So let me quickly show you the chart a little bit more in detail. So I'm going to quickly bring down the chart of Tesla so you guys can see what that looked like at the time. All right, here's the chart. So what we're looking at here is, again, you can see we had a very steep sell-off that turned into a complete vertical drop. Right, so it was this, and then the bottom just kind of gave. So once we had some sort of bullish reversals take place, and I'll show you guys a little bit more about that shortly, we ended up selling a June 120, 110 put spread. So we didn't try to bottom tick. That's not the point here. But what I ended up doing is we ended up going way out of the money. A 120 put is down here. Okay. So the 120 put from the day I sold it on the 16th, which was this day here. Okay. On this day here, the 120 strike was, let's call it 20% out of the money, or 20% below the current market price. So obviously I was putting on a bullish bet, but the market didn't have to go higher for me to make money. It could go sideways, it could go higher, and it could have gone up to 20% or so against me. I mean, literally you could have been 100% wrong on this trade, okay? And you could still make money by the expiration. And again, note here was really important. It didn't use February or March options or even April options. I used June options. This is really important, and I went way out of the money. Okay, so the combination of all these things, including the fact that you're looking at very specific trades with the vertical drop-off and the vertical rally in the other examples, is really what's key, and that's what a lot of people don't do. So fast forward, by March 16th, about a month later, the spread was reduced to 43 cents. In other words, I got to keep $1.82 of income of the $2.25 I took in. If you want to put this in options terminology, I basically made $182 per one-time doings with a very, very conservative way of putting on a trade. Let's look at another example. Here's LinkedIn. Okay, this is a stock that, as you can see, again, the same principle. We had a fairly steep sell-off, and ultimately the stock just completely went into vertical drop mode. It got very, very exhausted from a momentum perspective. It came into a confluence area of technical support if you kind of flip back a little bit. And ultimately, we got to a point where the options got very, very attractive for us to sell an out-of-money put spread. So what did we do? On February 8th, 2016, we sold an April 85 put spread for 95 cents. So again, let me quickly go in and show you that chart so you guys can have a look at this. And here we are. Okay. So here we go. So here's the chart here. And again, if we look at February 8th, 2016, you will see that was somewhere around here. The stock had not yet bottomed out, but we had such extreme emotions taking place that we managed to go ahead and sell an April 90 short strike put, and buy against that for protection an 85 strike put. Okay. Now at the time when I did this, this was still giving us a little bit of wiggle room. In fact, the stock could have dropped about another almost 10%. So again, the stock here too, it didn't have to rally for me to make money, right? It didn't have to rally. It could have gone sideways. And again, it could have gone against me to a decent point. Okay. So I'm seeing some really good questions here, folks. I'm going to do some Q&A shortly. And yes, you guys, I think you guys are starting to get the point of this, which is really, really important. There's some really key risk parameters here. So what happened here, so let me just quickly fast forward so you can see. By March 16th, the spread was reduced to 43 cents. But note, the stock didn't go higher, even though I was making a quasi-bullish bet, right? And by April, the put spread was basically worthless, okay? I got to keep my entire 95 cents of premium for monthly income, right? And again, the key here is that the stock didn't have to go higher. It simply went sideways, all right? And it even could go enough to the downside, okay? So a couple of pro tips here that I want to go through before we go through some really juicy examples and show you guys something really, really special. Number one, it's really important to think like a pro, because the objective here is not to pick winners, but rather to stay out of losers. Okay, this is really, really important. The objective is not to pick winners, but rather to stay out of losing trades. That's really, really important. Doing this will ensure that the winning trades essentially just take care of themselves. Yeah? Let me say this again. By making sure you're basically focusing on risk management, which is really what the strategy is all about, you're going to be risk managing your losers, and the winners are going to take care of themselves. Of course, like with anything, I'm not guaranteeing to you gold without any sort of work here. Anything is going to have some losing trades, but that's exactly the part of the tuition that you paid for trading or investing, or the cost of business, if you will. But it's also why we are focusing on risk managing more than anything else. Okay. So keep in mind, like I said before we look at a couple more important charts, that you're making a bet on where the market will most likely not be at a certain time in the future. I'm going to say that again. This is really important. By selling options or selling credit spreads the way I do it, you're making a specific bet on where the market is not going to be at a certain time in the future. Conversely, if you buy options, okay, or if you are a stock buyer or an ETF buyer, whatever you're buying, the only way you're going to be making money is if the stock or the ETF or whatever it is, or the futures contract or the currency goes in the direction that you think it is supposed to go. Okay, so if you start thinking about it that way, you're starting to really think like a professional, certainly through the lens of generating income on a sort of monthly or multi-month or quarterly basis. Okay, so stock traders and options buyers will only ever make money if the stock or the underlying asset goes in their desired direction. Option sellers, on the other hand, on average, can actually still be totally wrong and still make money. Okay? So this is really, really important for you guys to understand. The other thing that's really important is you have to give yourself time. I think one of the most important things, reasons why, or one of the main reasons, why people tend to lose money when they trade options is because they don't give themselves enough time. Time actually should be on your side, regardless of whether you're buying or selling options, by the way. But perfect timing is absolutely not necessary with the strategy. Like you saw, for example, in this LinkedIn example, I didn't need perfect timing. It doesn't really matter where I sold the trade here. Obviously, we were trying to take advantage of a very steep and severe oversold level, but I didn't have to enter that trade that very second or that very day. I still had several days at least within which I could do that trade. So perfect timing is not necessary. And many traders fail because they don't really give their ideas adequate time to work out. That's really important. And so that's why what we're trying to do with the strategy, and the main objective is to basically build a portfolio of these credit spreads, right? These short option spreads layered over various months into the future, because then ultimately what's going to happen is you're going to be having a portfolio of options that expire each month, giving you that income. But that's the really important thing, is that you have to plan these trades ahead. Okay? So you got to plan your income stream months ahead. A lot of people try to focus on weekly options or things expiring, right around the corner. And that to me is more akin to gambling than anything else. What you're trying to do is you're trying to plan out your income basically for the next few months ahead of time. Okay? And the rest really is risk management. So, again, much of the reason why people lose money when it comes to selling option spreads is because basically they're focusing on structuring the trades the wrong way. So buying premium as opposed to selling premium, that's a whole nother basic issue, but of course here we're simply talking about options credit spreads anyway. So I want you to primarily think of the credit spread or the income spread as your main income. So like what I do is in any new month I come in, my primary objective is to put on new trades, put on new income trades, and then all the swing trades and everything else that we do is what I would consider the bonus. Okay, because the market doesn't always move a lot. So from a swing trading perspective, you won't always have the greatest opportunities every month, but you always have opportunity to sell spreads, because you always can find opportunities where a market has gone into vertical overshooting, both to the upside or to the downside in any market. Okay. The thing is that returns in trading and investing, as many of you folks probably know, the returns are not linear. There's really no such thing as linear returns. So one of the questions that I'm already seeing popping up here a couple of times is, how do you actually find these kind of trades, and how do you qualify something as extremely overbought or let's say oversold, and how do you actually get to find these kind of setups that are then really prone to at least some sort of mean reversion or a sideways move where we can go in and apply this option selling strategy? Well, you can see, for example, this is shares of Tesla. It had a very steep rally, went into vertical overshooting mode, and we got these nice blue down arrows, right? You then have for example, this is Google. Again, a very steep rally, then it gaps even higher after earnings, and this was actually just, I believe this was just a few months ago. And you can see a lot of these blue arrows popping up here once after the earnings report, and again, the stock actually ends up dropping quite a bit, but really, again, the point here is it didn't continue higher. It got very, very overbought, right? So we have these blue down arrows. How about Amazon.com? This is just a few months ago. You can see the stock had already ascended quite steeply throughout the year. Then it went very, very steep to rally, and then it got very overbought, and it was a beautiful trade to put on, at least for a few weeks before the earnings report. And you don't want by the way, a little side tip here that I haven't mentioned yet. You don't want to put this trade on and hold it through earnings. That's really important for these kind of credit spreads, okay? You do not want to hold these kind of trades through earnings. That's another big, mistake that people do. So what I do is I use what I call it my TST, or Steady Trader Vertical X Pro indicator and scanner. What it does is it automatically finds for me these very overbought and oversold stocks basically with the click of a button. It's essentially, the opportunities that I find for this strategy are almost solely coming from this indicator. Okay, so let's see. I'm going to show you guys a couple more things here, and I'll show you some current example as well. So what the indicator actually specifically does, it tends to find these stocks that have vertical charts, right? It's a very high probability way of setting up these trades that I've just talked about. Okay, and I'm going to give you guys some more examples in just a second. And it allows us to find basically the highest probability spot to end up selling options, because you can sell options anywhere along a stock's rally or sideways chop or anywhere, but in my opinion, the only very high probability way of doing this is by finding the extremities of emotions, okay? And so what the indicator does, not only does it find you these opportunities, it also forces you to develop a watch list. And I think that's really, really important, that you are developing a watch list over time. Many people just kind of randomly fumble around the market, and that's not really a way forward, okay? And also it's going to keep you from buying or selling at the exact worst spot. So if the indicator finds you extreme overbought or extreme oversold stocks, it's going to also keep you from buying or selling at the exact worst spot. So in other words, it's going to keep you from chasing stocks higher or lower, when really what you should be doing is the opposite, okay? So we also use this for risk management in my advisory and money management services as well. And quite frankly, most importantly, probably, at least for me, it really forces me to be patient, calm, and collected. To me, that's the most important thing that the indicator does. Okay, so right now the indicator actually works for Thinkorswim, TradeStation, and Ninja Trader. And I'll show you guys a couple of examples here. Like, for example, let me just bring down the chart here of how it works, and so you can see that the high probability way. For example, so let me just show a couple of charts here, so you can see how this works. So let's see, for example, let me quickly bring up the scanner here as well, so you guys can see this. There we are. Okay. So we actually just got a signal in Amgen, just so you guys know. We have the scanners pop up like this, okay? And then all I really do is I look for, so for example, we have a very overbought signal right now in ABBV, which is a biotechnology stock. Doesn't mean you have to short it, but it does give us a very high probability to do something on the short out of money call spread type of setup, okay? So that's one thing we're looking at. Again, we have something in Amgen again that just popped up, and also, for example, just a few days ago or a few weeks ago, we had Boeing, right? Beautiful oversold, overbought readings. We then had an opportunity to sell out of money call spreads. We kept them on it for a few weeks, and we are making maximum profits in the stock. And you can see it's all because it all pops up on our indicator. All I have to do is kind of flip through here and see if there's opportunities of extreme overbought or oversold readings. Yeah. So that's the way I find these. And I know we're going to do Q&A here in just a second. But again, the way I find these opportunities essentially is through this indicator, and it allows me to build a very nice portfolio of these kind of trades over time. Okay. So again, the objective here is not necessarily to just go ahead and find one-off trades, but we're trying to build an entire portfolio. So look at, for example, here. This is Celgene. Okay, let me just quickly show you here. Celgene, a stock. Again, we got these really overbought readings. And again, the point is we're trying to make a bet that the stock is not going to go much higher, because it's going to give you an opportunity to sell out of the money call spreads, or if you have a really big sell-off, out of the money put spreads. Like, for example, I think just last week we got a whole bunch of opportunities here. This is the bearish version of it. XL Capital and a lot of the reinsurance companies got extremely oversold last week ahead of the hurricane, or just before the hurricane struck, and you can see these signals here. And once we got an bullish reversal, in this case, this is an outside candle, which I'm sure many of you guys know, given the candlestick form here, we had a beautiful opportunity to sell out of the money put spreads. So again, it's a matter of finding these things, which is really, really important to find these the overbought and oversold readings. So I'd like to answer a couple of questions here, and actually I'd like to answer all of your questions to be honest with you. So if you want to go ahead and type in some questions, that would be great. What I would like to offer you though is I'd like to offer you my Options Income Secrets course, which comes along with the indicator, and it's going to learn all the details of how to generate monthly income using monthly or quarterly income using this kind of strategy. It's a very low stress strategy, and it's all about focusing on the very, very specific setup. Okay, you want to use the way the options the pros do. You want to use options the way the pros do, and again, look for a very specific setup. Okay, we have about an 89% chance of winning trades. You're going to get a bonus ebook along with this, and it's just $197 if you go to thesteadytrader.com/income. Okay, and I'll get to all your questions here in just a second. Thank you, Becky, for typing in the link there. So again, this is an evergreen course. It doesn't go away. Okay, in fact, if I add new courses to it, you'll get those as well. This is just a one-time thing. You get a beautiful ebook with it with all the details outlined there as well. Also, again, there's a brand new module I added just a short while ago on the Iron Condor, doing it correctly, very specifically for option selling, using it exactly the way that we just talked about. There's a very specific way you're going to use an options Iron Condor to basically double your option selling returns. And that's been a really, really beautiful strategy for a lot of folks that have applied this. Again, it's thesteadytrader.com/income. Also, and I'll get to your questions here in just a second, what you're going to get a personal mentoring phone call with me if you purchase this today. So not only do you get the course and the ebook and the indicator, which I'll talk about more in just a second, you'll also be able to get on the phone with me and we'll personally walk you through not just the strategy, but also just do a general mentoring phone call with you one-on-one. Okay, so that's also included. And lastly, and this is really important, we also do from time to time, we do live bonus sessions for owners of the course. So like right now, for example, our next one is scheduled for Wednesday, October 27th. We actually just did one yesterday. So if anyone's interested, if anyone who purchases this today is interested in the recording of yesterday's webinar, you could just let us know. Once you purchase it, send us an email to support@thesteadytrader.com and we'll send you that recording as well. So so it's not just a one-off thing. You'll also see ongoing education here as well. Okay. So what are some of the things that you learn in here? By the way, this course is not for people who are trying to gamble. I really specifically make these courses for people who really want to generate income in the markets and are serious about it. So that's just an important little bit there. But again, what the option strategy consists of is essentially 80 to 90% profitable trades if it's done correctly. Again, that's really, really important. Okay. Most investors use options the wrong way. You got to make sure you start using the right way and the highest probability way. And that's why we're using a very specific setup. I'm not just telling you to go ahead and start selling options or selling weekly options or things like that. I'm really a big fan of using this correctly. Again, we're trying to generate and build a portfolio of income trades that you can ultimately then see income come in. And it really shouldn't take long. It takes you about 3 months to build that portfolio because you could be selling new option spreads, every month going forward, okay? And you want to stop being a gambler and really start becoming the casino, okay? Again, you learn why the odds are dramatically in favor of option selling, the power of time decay, and how theta can literally allow you to make money in your sleep or on vacation or over the weekend. So these are all little nitbits that we're adding in there in the course. And again, the point is to turn you into an income generating machine in addition, of course, to you doing your additional swing trades and whatever else that you like to do. But it's really important here that you also diversify the strategy among different sectors and industries and asset classes, even if you'd like to. So that's really important. Again, you're going to learn all of that in the course as well. You'll learn where to take your profits and the whole risk management process. I see a lot of questions on that here. I'll give you guys some more information on that here in just a second as well. Again, the risk management process is really, really important with all of this. Okay, so that's what this is. Again, what you get with it as well is the indicator. Okay, and that's really important For those of you guys that like to use it, it's called a TSD Vertical X Pro indicator, and it's going to allow you to find these trades. Okay, and right now it is available and works for the Thinkorswim TradeStation and NinjaTrader platform. So let me go back here and let's go through all your questions, because I really want to make sure we address all your questions, because otherwise I haven't done my job here. So let's go through everything. So people are asking, what's the risk management process? So let's just go through and have a look at this. So for example, let's just go through a trade that we had in Boeing. Okay, so you can see this is the indicator, gave us a very overbought reading here, right, in January, and then the stock actually dropped about 5%. It didn't really recapture the previous highs there until, let's see, this was January 26th, until about 3-4 weeks later. So my general risk management process will allow me to take 50% to close the position or reduce the position by about 50% if I get to 30% of maximum profit. And any single time this happens, when you do it at the right spot, there's, like I said, about an 80 to 90% chance of this taking place, right? So again, you wait for these extremely overbought readings, and then you sell out of the money call spread in this case. And again, you can do the same thing on the downside. Okay? Right. So this is not about getting assigned to trades. You shouldn't be getting assigned to anything. This is why we're doing spreads. Can you do the strategy in IRA? I know some retirement accounts will allow you to sell credit spreads, but honestly, this is something you need to check with your broker and your financial advisor if you have one. Okay. For those of you guys that are purchasing this today, by the way, because I'm seeing a lot of questions here. If you're purchasing this today, you'll also get a chance to take a trial for $7 of my Clubhouse membership, which is my monthly membership, where I actually show you trades that I'm doing in real time. We send out daily videos and so on and so forth. But what's really important for here. Oh, good. So CEP says he does credit spreads in his IRA account. So yes, let's see who was asking this before. Oops, who was asking this before? Thank you very much. Thank you very much, guys, and Dan Roberts as well. So yes, the answer here seems to be that you can do credit spreads in your IRA. So that's very good. Thank you, guys. I really appreciate you trying. This is such a great group you got going on here, Steve. This is a real pleasure to talk to these guys and converse. Real pleasure. I'm really enjoying this. So that's what we're looking to do. We're looking for a very specific point in time to do these spreads. Again, don't want to randomly fumble around the market. We want to look for very specific points in time to put on these trades. How far out of the money do you go? I mean, that's a great question. It really depends what the implied volatility is. And again, that's what you're going to learn. At least that's part of what you're going to learn in the course. Keep in mind, there's also a phone call that you get with me. There's the bonus webinars on an ongoing basis that we provide, and of course the indicators. So, sometimes, like for example, some of the examples I showed you before, if you get to extreme emotions, you'll be able to go ahead and sell the short strike literally. Like I said, I mean, you saw before, between 10, 15, 20+% out of the money, right? But it really depends on the situation. Again, that's what the course is for, and that's where I'm here to talk to you personally as well, and to continue education. So, yes, if you guys want to, once you purchase this, and again, I only make the Clubhouse available for people who have purchased education. Why? Because it's really important for me that you understand that you want to learn. If all you want to do is copy some trade ideas, number one, I promise you're never going to make money that way. And number two, it's just not really how it works. Yeah. So, this is a one-time thing. This 197 is a one-time thing. This is a course. Okay. It's a video series that you watch. Again, you get the personal phone call with me, and you will get to join the bonus webinars. And yes, of course, the indicator is also included. Yes, absolutely. So Sean Dogan, you're asking about the club. It's a $7 trial that you can take and watch us for that. Unfortunately, the indicator does not work for TC2000. The indicator right now the indicator works for Thinkorswim, for TradeStation, and for NinjaTrader. By the way, if you really want to use the indicator, you can, and you don't have any of the other platforms, you can download, I believe, a free version of NinjaTrader, and then you can just use the indicator. So again, you also get the mentoring phone call with me, and the Clubhouse after the first month of trial is $97 a month, and it's a process. It's daily videos. It's again, it's nothing hectic. We're not day trading. We're showing you guys a process that you can not only make money from a near-term perspective, but we're also really focused on a lot of medium and longer-term plays, so you can really manage your money through a lens of income over time. Okay, the indicator right now works for Thinkorswim, for TradeStation, and for NinjaTrader. All right. All right. Let's see here. Yes, the indicator is included in this, and what else were you guys asking? Yes, the live bonus sessions are going to be taking place from time to time. So it's also ongoing education here, as I reveal it, because I really want you guys to make money. It's I've seen it so many times, so many times in my career of people getting bad education or even bad advice, and they just are losing money in the markets really for no reason. So we don't want that. We want to show you guys a way to make money in the markets over time by correctly building a portfolio, in this case of credit spreads that are placed at the right spots. So like, for example, here in Boeing, you sell out of money call spreads when the indicator goes off, indicator or not, it doesn't really matter. You're looking for extremities of emotions. So if you don't have one of the platforms, it's an indicator, it's not really a big deal. Again, you can, if you want to, download NinjaTrader for free and use the indicator, or again, it's primarily education to me that's important for you. Yes, so Fred is asking, can you estimate approximately how many trades can be found on a monthly basis? I don't look at it on a weekly basis, Fred, because we're not looking to do a weekly trade. We're looking to plan income, let's say between 1.5 to 3 months at the most in the future ahead. Okay. So I usually find between 3 to 5 trades, new trades that I can put on any given month, just like the ones here in Boeing, and so on and so forth, and everything that I just showed you. Okay. Yeah, exactly. Yeah. No, I would not place a trade in Boeing at this point. No, I would not. I would not place. This is just an example. The point of the Boeing example here wasn't to tell you that this is something you need to do right now. Again, I'm not giving advice. This is education. But the key is the signal happened here in July, and that's where we put the trade on. Yeah, not now. Not now. I think actually Boeing is actually a breakout candidate, to be quite frank. So I would, if anything, I'd do the opposite. I'd be a buyer of Boeing. Okay. Yes, sure. Let's look at one or two more examples. Like I said, another one we're watching right now is Amgen. Now, Amgen to me is in a very hot group right now of biotechnology stocks. I'm a little bit hesitant of doing it right now, but the opportunity that you get here is to sell far out of money call spreads does stand. So let's see what else. Yeah, actually, one stock that we just did a trade on the other day is in Apple. In fact, I did it yesterday. Here the indicator did not signal it, but it's the same principle. By the way, as you can see, we had a signal here in Apple where we could have sold beautiful out of the money call spreads, and look what happened. The stock went sideways and ultimately went lower. We actually just sold call spreads, just in full disclosure, in Apple. It didn't give a signal, but the same principles applied. And that's why it's important that you guys take the education and you take the course and you talk to me on the phone if you'd like to take me up on the phone call. Again, it's included in the price here, and you join the ongoing education. We do webinars every once in a while, and so you understand how to find this. But we did this in the Clubhouse. I shared it in real time with the Clubhouse members as well yesterday, by text message actually, and in the morning video as well. So it's all there. Again, it's all about having a non-hectic lifestyle, and as far as I'm concerned, and certainly when it comes to trading and investing, it doesn't have to be hectic. A lot of people have this idea that trading and investing needs to be super hectic because they watch movies like Wall Street on TV. But do you guys know why Wall Street why like all these hectic trading floors, why they're like misleading? Why that's not really how you make money? Does anyone know what the basic issue is that? It's because all those movies represent the sell side. And I can tell you, I used to be an investment banker. I used to work on those trading floors. That's the sell side, folks. That is hectic. But if you go to any respectable trader, and I'm sure Stephen would agree with you on this, you've got any respectable hedge fund, it's actually very quiet. It should be calm and collect. There's no random craziness because you're not taking orders from from clients. You actually have to do research and do trades, right? So that's that. So listen, guys, I mean, I've really appreciated my time here. I very much appreciate it. I hope this makes sense to you. Again, the offer link is here, thesitetrader.com/income. The point here is to create an income stream looking out over the next few months. Yes, no, I would not be doing it right now in BA. I'm going to again go back to this, Carol. I would not be doing it right now in BA because the signal, the stock was really overbought here, not here. Right now it's had time to consolidate, okay? And now it actually looks like it might be ready to break higher. But if you did this trade in July, you would have made at least 30 to 50% of maximum profit already of the maximum credit that we took in, literally within a couple, 2-3 weeks later, and that's long past. So I closed out this trade in August because we already reached our profit target. But again, that's the trade management stuff that you're going to learn in the course, and that's important. Thank you very much, Anne. I very appreciate it. Anne says thank you so much for sharing, very enlightening and eye-opening. I very much appreciate it. I hope to have you on board. I'd love to help you out personally. Again, that's what I'm trying to do. I'm not here to teach you something that doesn't work. I don't believe in that. I just want you guys to have a way of actually generating income over time, and that's really important. You're very welcome, Paulette. Let's see. Eric is asking, how do you make money when the trade goes against you? Well, Eric, I'm really literally out of time right now, but that's what the course is about. Basically, the way it works is when you sell call or put spreads, you actually have a lot of room for error. So in this case, in Boeing, we actually, because you sell out of the money call spreads, the stock doesn't have to go down, or it can also go sideways or even against you to a certain point. Again, that's the intricacies of basically selling call and put spreads. So I would really encourage you to take the course. Again, get on the phone with me. It's all free, included in the course. Again, it's $197. It's a one-time payment. There's no recurring fee here. I'd love to see you guys there. Again, the indicator is included, as is ongoing education. Great pleasure, folks. Really appreciate it. Stephen, thank you so much. I very much appreciate you having me on here. Also, thanks for Becky for setting up the webinar. And I wish everyone a great rest of your day. Have a good evening. Stay safe and take care.
Thank you, Serge. Very good information. Everybody, you ought to take a look at his training. It's going to give you a very, very, expanded outlook as far as how you can make money when things are a different program to make money. So Serge is one of your top professional traders, in my opinion. You want to take advantage of his information. So Serge, thank you very much. I hope when you get back to Florida, you find everything okay. And with that, everybody have a good evening. We will see you bright and early in the chat rooms. We'll see you then.